same time, we'll make sure that the webinar is meets our needs in terms of our professional development, and at the same time, it addresses what we have been talking about, financial analysis for procurement professionals, financial analysis for us as people that are engaged with subcontractors, people that are engaged with contractors, people that make that analyze contracts, people that prepare bills of quantities, people that shortlist contractors, people that design frameworks and all kind of procurement strategy. Without going off the track, I'll start by sharing the presentation slides, and I'll go through it in slowly so that all of us can follow it. I can give a brief overview of this presentation in that we will not go into the technical nitty-gritty of financial analysis in terms of calculating ratios and doing all of that, because we don't have enough time for that. Neither is this the proper platform for us to go into it. But what the discussion is going to be about today will be about what we should know, the soft things that you and I can imbibe in our analysis of financial statement. The soft things that you and I can imbibe that can help us to make better informed decisions as procurement professionals, as contract managers, as quantity surveyors, or even as in our own personal lives when it comes to analyzing financial statement and making sense out of the numbers to help us make better informed decisions. So I will start the presentation now, and we can just go through it. Then you can keep your questions till the end of the presentation. There will be time for us to discuss these questions and contributions to what we are having. Okay. I believe we can all see my screen right now. So, like I said, we are discussing analysis of financial statement for procurement professionals. So the overview or the outline of the presentation is as this: the brief overview of financial reporting, what it entails, what governs it, what are the rules behind it, then the simple components of financial statements, what you will see in a typical financial statement, and then user interests. The financial statements have interest to various type of people, various groups of people. We'll discuss briefly the interest of this type of people and what they are always looking for in financial statements. Also, then we'll now go into the financial analysis proper. But in this regard, we will only talk about the guiding principles of financial analysis and what you and I should look out for concerning financial analysis. But we won't spend a lot of time trying to go into the nitty-gritty and the calculations because, like I said, we don't have the platform for that. At the end of it, we'll focus more on ratio analysis because it is like this. It is actually the strength of financial analysis. After all the simple comparison and horizontal and vertical analysis, ratio analysis seems to be what gives analysts the best information and the best guide when it comes to making sense out of financial statements. Then at the end of the day, we'll talk about the facts behind the figures, what to look out for, and we'll conclude by looking at the various applications, especially for us as quantity surveyors in the construction industry. So the brief overview. I said financial reports are governed by regulation. What we mean by that is that for us to have a uniformity and consistency in reporting financial activities of companies, there must be rules governing it. And because this financial industry and financial things that are related to financial industry generally, they are systemic to the economy and they are systemic to the nation. There must be laws that are guiding it, else there will be issues. So generally, what we are saying is that financial reporting is regulated. It is controlled by government. It is controlled by law. It is controlled so that information taken from there does not impact us in the wrong way, does not impact the economy in the wrong way, and people are safe and they find confidence in using such information. So, and in this guide that has been provided, it is provided in form of standards. I'm sure that most of us are aware of one form of standard or the other. For example, in the construction industry, we have building standards, and we have British standard when it comes to construction. And for us here in Qatar, we have Qatar Construction, QCS, Qatar Construction Standards. And these standards change over time. What the standard does is to regulate and to guide how we conduct our activities. When it comes to financial reporting, it guides how different professionals or different people from different jurisdictions of the world are able to report on the same thing, and there is consistency in reporting. So what I had here on the screen, I mentioned that there are different standards, but people that are reporting are required by law to state the standard that they have used, and different jurisdictions have adopted different financial standards. I said that there are different standards that include the financial reporting standard, and the most recent one, the IFRS, the International Financial Reporting Standard. That is what has been adopted by most jurisdictions in the world. For example, in Nigeria, we used to have what they call Nigerian General Accepted Accounting Principle, what they call the NGAAP, which is a derivative of the old previous accounting standard in generally accepted accounting principle, the GAAP. But all of these have evolved into more acceptable and more generally accepted standard in this type of IFRS. I also mentioned here that in Qatar, we use IFRS 9, IFRS 15, and 16. Now, what you can see in this variant of the reporting standard, it's that it deals with different parts of reporting. For example, IFRS 9, 15, and 16 had to do with something around how we take provisions and things like that. But we won't go into that level of discussion here. But generally, what we just want to know is that when it comes to financial reporting, it is regulated, and there are standards that have been given by different jurisdictions of the world that guides how these reports are generated. And what is most important again is that in every of those reports, or this report that we are talking about, the people reporting must identify and state the particular standard that they have used in their reporting. For us as quantity surveyors, most of us are used to the standard and how reports, how standard guide what we do. For example, when we do measurements, we use standard methods of measurement. We use new rules of measurement. And the condition of contract states that we must state the method of measurement that we have used, so that even if another contractor or another person or another consultant is reviewing those documents in another part of the world, so far you have stated the method of measurement that you have used, the person will be able to look at the method of measurement and look at what guides it, the rules of measurement, and both of you will be on the same page. That is the same mindset that we should have with financial reporting. Then the general principle of financial reporting are that the financial report must have relevance to the purpose for which it was done. It must have relevance to the industry. It must have relevance to the sector, the economy, and the people that need the information. We are going to get into that when we come to user interest. But for now, what the principle about relevance has to talk about is that the people that are looking for this information, the information must have relevance to them. In addition, there must be reliability. Reliability in the sense that people that analyze the financial statements, people that consume this financial information in this financial report, they must be able to rely on it to make informed decisions. So to explain this the reliability, we said it must be a faithful representation of what has happened, the actual financial position, the actual financial situation of a particular entity. There must be neutrality in the reporting. That means the auditors that are reporting, the auditors that are certifying the financial statements must take a neutral position. They shouldn't be biased and putting things that are not supposed to be there inside the report. They shouldn't be on one side. They shouldn't be prejudiced in any of their reporting, so that people that take that information, they can rely on it and it is relevant to them. Then materially, it must be error-free. As much as practically possible, the reporting should be error-free. It should be done according to standard. It should be done according to internationally accepted practices. It should be done according to the rules of reporting, the rules of financial reporting, and all of that and all of that. So as much as possible, it must be error-free, it must be complete, and it must be prudent. Prudent in the sense that the information delivered in it is relevant to people that are using it, and they can easily make deductions from it. Then one of the things that we are going to go on to discuss further today is about comparability and understandability of those reports. The people that are using the information, or the people that need the information, the users of the information, they must be able to make comparison from the information that has been presented. And to make it possible, to make it easy for them to make this comparison, to make it possible for them to understand this report, it must be presented in a particular format. It must be presented in a layout that makes it easy. And we'll still discuss about that, the issues with the layout, the issue with the structure of financial reporting, how it's different from different jurisdictions, how it's different from different, how it's different in different companies and different organizations, especially when it comes to things around accounting principle or accounting policies of different organizations. We can move on to the next slide. So we have the components of the financial statement. Most of us are aware of it. We have the balance sheet. The balance sheet is the statement of financial position of an organization. So today they will say Amazon is a $1 trillion company. Tomorrow they will say Google is a $900 billion company. It is in the financial statement of the organization that you see this, and the financial statement that is relevant to this is the balance sheet. The balance sheets give the financial position of organization at a particular point in time. But what it does is it demonstrates the assets and the liabilities of the company, and that's how you're able to measure and categorize the size of the company. So you won't say the size of the company is the number of people that are in the organization that says that they have so many people. You won't say the size of the organization is the number of buildings that they own, but it is what is truly represented in the balance sheet that gives the size of the company at a particular point in time. Then you also have statement of financial performance in income statement. Income statement, like the name rightly says, tells you how well the company is able to convert its assets, right, into how well is able to convert its assets, how well is able to earn from the effort and all the things that the company has put in to make money, to have profitability. And at times, the income statement might report a loss. We might not be able to go into that, but that is just the reality of it. So when you want to see the financial performance of the company, when you want to see how well the company is able to deal with its sales, its stocks, its activities generally, you come into the income statement, and it will give you a picture of the financial performance of a company at a particular point in time. We have the statement of change in equity. We have the statement of cash flow. Statement of cash flow is a lot simpler. Just we understand that cash is the currency. It is the blood of every organization. Cash is the currency, is the blood of every organization. At every point in time, every business needs cash to run its operation. Every business needs cash to run their operation, and they need this cash to be available as and when due. If I'm able to bring it home, for most of us that are salary earners, we'll expect that by a particular point in time, when our companies are supposed to pay us salary, they should pay that amount. They should pay the salary. The reason they're able to pay it is because they have the cash flow to do it. And for us that are involved in procurement and we want to make payments to our suppliers and all that, the reason we're able to fulfill those obligations is because we have cash to do it. And that's why cash is very important in every organization. Cash actually is the blood of the organization. So from the statement of cash flow, we can make deduction and understand how a business is run and how the business is doing. Then we also have notes to the financial statement, or we call it notes to the account. I'm sure most of us have seen a financial statement before. When you see it, you see beside different aspects of it, especially in the balance sheet, in the financial state, in the cash flow statement, you will see numbers beside it. Those numbers refer to a particular note at the inside the statement. What those notes, their function is to explain things that cannot be written down in the particular aspect of the financial statement. For example, look inside the balance sheet, you see something about net assets, and you see a number to it. And when you go into that, where that number reference in the notes to the account, it will explain why those numbers are looking like what they have. If I'm able to bring it down a bit, most of us are used to contractors, but we also have contractors that are also into supplies. For example, I can say that you have a contractor that is doing construction, doing infrastructure, but at the same time, the contractor is also providing bitumen or asphalt. The contractor has an asphalt plant. So when you see their statement of performance in their income statement, you might see a note, or maybe you see in their balance sheet against assets, you see a note, right? And you see something about the way their asset has either increased over a very short period of time or it has decreased. Let me say, for example, it has increased year-on-year comparison, and you see a number there. You will now go into the notes to the accounts, notes to the financial statement. The notes will tell you that, oh, within this financial period, they acquired a new plant. Within this financial period, they upgraded their current plant. And that's why you can see that, oh, this asset has increased. At times, you will see how the amortization and the depreciation has been calculated, and all of this kind of information are contained in the notes to the account. Then we'll go to the director's report. Now, the director's report is very important for analysis because every now and again, a business is a going concern. Many things are happening over a period of time, and the person that is involved in day-to-day running of the business is the director, the managing director in this particular case. The director's report will normally give an overview of what happened within the period under review, right? Let's say a 12-month review. The director's report will be contained in the report. The director's report will address like, oh, over this 12-month period under review, we bought additional plants. Our performance was generally better. Oh, we made a loss, and the reason why we made a loss is because that we diversified into something that we have not done before, or we took a very, very strong provision because we are looking ahead to, make adjustments in our future plans. So we need to read the director's report. We need to understand the reasoning, the thinking of the company, and what were the reasons why they took some decision and why their financial position in balance sheet and income statement looks like what it looks like. And finally, the auditor's report. And I have this where I said where applicable. Where applicable in that most of the time for big companies, they require auditor's report. For smaller companies, you might not see auditor's report. But for the big companies, why you see the auditor's report, the auditor's report will tell you things like the basis and their opinion for writing what they're writing. Concerning the report. You also see things like where they mention, okay, the type of financial standard that they apply. Maybe it's IFRS, maybe it's IFRS 9, maybe it's IAS. They'll write all of that inside their report. And if there are things that are very, 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 that are very crucial that the public needs to know, they'll put it inside there. Before I forget, in most jurisdictions, like I said, this is regulated. They require publicly quoted companies, like we know the Googles of this world, the Amazons of this world, the Facebook of this world, the Microsoft of this world. The Federal Exchange Commission and the Security and Exchange Commission generally require companies to give their audited report by a particular period in time. Some every 6 months, some every 1 year, and at times some form of report every quarter. The reason is that these companies have grown so big, they are publicly quoted, and a lot of people have stake in them. So they have to be as transparent and as accountable as much as possible. And that is why you will see an auditor, the companies that audit them, they have to be independent, and they have to give this kind of auditor's report where they tell you, this is the current state of the company, these are the things that we saw inside, These are the things that we think should be of concern to people that are using the information. These are the things that we think the company has done right, and this is where we think that there should be no concern, or as much as possible, information that shows that they are independent and they are as transparent as it can be. So basically, in simple form, these are the components of the financial statement. You will see the balance sheet, you will see the income statement, change in equity statement, you see the cash flow statement, then the notes to the account, the director's report, and where applicable, like I said, the auditor's report. Then we can go on next to the typical specimen of the component. So we have this here, the balance sheet. For you to understand the size of the company, like I said, it is from the balance sheet. It is from the assets and the liabilities that you understand how big this company is. So if you are going to see anything, for example, we are looking at this, the balance sheet of this company, and it's telling us that as at March 31st of March 2021, which is the reporting period, and a report based on a point in time. We're going to come to that as well. These are one of the deficiencies of a balance sheet. It only gives the picture at a particular point in time. It says that at a particular point in time, this is the size of this company, 2.665 million pounds company. So if there's anything at all that we can take from this, our discussion here today, is the thing that, how do I understand, how do I get the information about the size of a company? It is in their balance sheet. If they mention tomorrow that Google is a $1 trillion company, then how do I get that information? I look into their balance sheet, and I can see the size of the company. Then we can also go here and see the typical income statement. Now you can see the income statement of this company, talking about the retained earnings, the dividends that is paid there to the shareholders. You have the revenue, the cost of sales. But what we can see in this structure, and the structure that we saw before, is that in financial statements, you will see on the vertical column, you will see on the columns, you will see year-on-year analysis. So here we can see 2009 and 2008. We'll also come to that to demonstrate why the information is possible, is presented in this format. Why you don't just see 2009 or 2008 alone. It is for comparison, like I mentioned earlier on. So this is a typical income statement, and it is reporting at as a particular time again, 31st of March, 2020, 31st of March. The year will also be in there. Let me see, for example, in this particular case, 2021. And we have a cash flow statement as well. Like I said, cash is the blood of any organization. Cash is the lifeline. It tells you where the money is coming from, where the money is going, how they are financing their activities, and things like that. But while we're not delving extensively in the cash flow statement, when we come to things like quick ratio in financial statement analysis, we'll discuss more about cash and why it is important for an organization. And we have notes to the account. Remember, I mentioned notes to the account, and if you had been taking notes while I was discussing on the balance sheet, there was a number where beside one of the statements, or let me just quickly go back to just show us something on the balance sheet. Now, if you look at the balance sheet that we have here, we have the fixed assets, tangible. The first line, we have fixed assets, and there's tangible assets, and there is a note there. That's what I was trying to explain when I said there are notes to the account. That the notes try to explain what you have, why you have the tangible assets the way you have it, what has happened within this period that you are reporting, what to look out for. So when we go further into note to the account, right here, we can see that number one is talking about tangible fixed assets, and it gives a breakdown of why you have the value that you have there. Other than the number, there's an explanation. It says vehicles sold during this year raised £9,000. The director's report states that the company properties have a current market value of £4 million. So those are the things that you are looking for as an analyst. Those are the things that will help you make informed decision when you're analyzing a financial statement, right? It is not just the numbers. It is not just in you working out with the ratios. It is in you understanding the notes to the account. As a matter of fact, inside this presentation, I mentioned something about understanding the facts behind the figures. These are the facts behind the figures, the notes to the account, how this goes on. Then we can now go on to the auditor's report. Inside the auditor's report, you have, like in this particular case, this information is generally available on the internet. We don't have to, it's not like it is a privileged information, it is secure. I mentioned earlier and I explained that the reports are the Exchange Commission and the government generally require companies, especially publicly quoted companies, to report their activities, and they report their financial position, within a particular period, 6 months, 1 year, and the like. So in the auditor's report, we can read here that the report said that the financial statement of a particular company that these auditors have done, Deloitte, we all know Deloitte is very popular auditors. It's saying that this is what guides their opinion concerning the particular review or audit that they have done of this company. Then in addition, it gives the basis for their opinion. These are the typical things that we will see in the audit report of, in the auditor's report of companies. You see their opinion and you will see the basis for their opinion. So this guides how we read, how we analyze those financial statements, how we take information from them, and how we use the information. We are seeing what the auditors are saying. We are seeing the basis for their report, and we are seeing all the other information that can help guide us on how we understand the financial statement. And lastly, in most auditors' report, you must see this. It must be signed by the person that is authorized to sign it. And the auditors will, most of the time, they'll put a caveat. They said the use of our report, right? They'll say this is the reason why we conducted this report. We conducted this audit. These are the things that we are taking into consideration while doing it. And if you're going to use this information, you must be informed that these are the reasons why we carried out the report. So these are the things that are important to us when we are making decision concerning, when we are reviewing financial reports of companies, and when we try to make informed decisions from them. So we look at the balance sheets, we look at the income statement, and to understand all of those numbers properly, we look at notes to the account, we look at the director's report, and finally, we look at the auditor's report. The auditor's report are signed, they give the basis of their opinion, and they give their opinion concerning the financial health, the financial situation of that company at a particular point in time. Now, I have mentioned that there are many people that have interest in financial information, in financial reports of company. Before now, we saw that the auditors are saying that if you're going to use the information we have provided, these are the basis why we have provided it. So we can look at some of the interests. We said these reports are of interest to different groups of people. Now, why I use the guided groups of people is that there are different classes of people, and we can put them in various groups that have interest. And most of the time, all of us will fall into a particular group of people that have interest in a particular, in the financial position of any company. At every point in time, we have interest in a particular, interest in a particular company, financial situation. Let me give an example. Most of us are employees somewhere. So we want to understand if our companies, if where we report to are able to pay our salaries. How do we know that? We look at our financials. We can see it, right? Some of us, we have shares in companies. We want to know if the company will continue to be a going concern. We look at the financial report. We want to know how much the companies will pay in terms of dividend and things like that. We see it in the financial report. So we can look at the different users and their interest. Here we have investors, investment risk. You want to know how good the company is. You want to know if the company will continue to pay dividends. You want to know if the management is strong and if your money is not at risk, your investment is not at risk. And it can be it can be an investor in different ways by you having equity, actually owning part of the business, or you lending to the business. More or less, you're an investor. And for you to protect your interest, you want to look at the company's financial statement. Another thing I didn't mention when we were talking about the director's report, some of the things that you will see in the director's report and in the company's financial will be the quality of management. If the people that are running the company, if they have track record, if there are people that are seasoned, if there are people that have demonstrated over time, right, that they have the acumen and the track record and the pedigree to deliver on promises and to grow the company. Another class of user are suppliers. Most of us are supplying services in some instances. At other times, we are supplying goods to companies. We are selling one thing or the other. We want to be sure that the company that you are selling to, they can pay for your service. Even if you own your own business, you're going to take brief. You have clients. You want to be sure that your clients have credit worthiness. They can pay for your service. How do you know that? You go into their financial statement, you see their financial strength. For example, if a company is giving you a brief, I can see that the value of the brief is $100 million. But you're looking at their balance sheet and you can see that this is a company that the overall size of the company and everything put together is less than $1 million. Then that is a red flag. But the only way you can know this is if you have the understanding of what a balance sheet is, if you have an understanding of what information to look for in a balance sheet. We also come to think about the quick ratio and asset test and things like that to see how well the company can pay, if they have the money, the money is to pay you as and when due. As customer and client, you want to be sure that the company will continue, right? You look at at their financial statement, you see if they are making profits year on year. Those are indicators that the company will probably continue and they'll be there in the long run. But if you look at the financial statement, you look at the income statement, and you are seeing every year they are making loss and losses, and you are seeing the director's report, you are seeing the auditor's report, they are giving some form of indication, some form of red flag, telling you that they are not certain that these companies will continue to be a going concern. So those are the kind of things that you want to look for in the financial statement. That's why it might be important to customers and clients to see that the company has continuity of service. And I mentioned this before, as employees, you want to be sure that your company, where you have the highest risk, because you are sold out to your organization, you report there every morning, and that is where you work. You want to be certain that they can pay your salary. You want to be certain that when it comes to the end of the month, there is money for them to pay, right? And you want to be certain that a year from now, 2 years from now, 3 years from now, this company that you have pitched your tent with, they are there to support you. It is in things like this that they are professional. I mean, in their financial report that you can get this information. Then the other part, tax authorities. This is very, very important, and this is crucial, especially in jurisdiction of the world where tax is very, very critical to funding for the government. People actually go to jail because of things like this. People actually go to jail when they don't report properly, when there are errors, or where they are, where it can, not even more than errors, now when it can be determined that you have committed a crime when you don't report properly. Because tax laws, tax and taxation and things around that are based on laws. And there are rules, there are laws guiding how reports should be so that you can pay the proper tax and you can pay it where you should pay it and things like that. And we have seen instances. I mean, if you just open the internet today, I can even just off my fingertips, I can come up with the latest one where you're saying one of the past president of the United States of America, they are reporting that there's a financial, there's a tax fraud in their company, that the chief financial officer is reporting on 2 books. What are they talking about? They are saying that there's a report where they have seen that they are paying so much tax, and there's another report where they're saying that the books appear to have been doctored and the full disclosures are not made, to the extent that the person has committed a tax fraud. The organization has committed a tax fraud. The company has been charged legally in the court, and it is a crime against the state when it comes to tax. So how do we see things like that? It is inside the financial statement. Then, of course, competitors and generally in the industry, for you to understand where you stand, for you to understand, for you to benchmark your practices, for you to benchmark against your competitors. You look at what they are doing, you look at the volume of their business, you look at the size of their balance sheets, for you to know even where you stand in the industry. Even inside the financial statement, you can see some of the activities that the companies are involved with, though you know that in their stock in trade might not be totally revealed. But at the same time, inside the financial statement, you can see and review and understand how you use that information, leverage on such information to be a better competitor in whatever industry that you are in. So those are the various users of financial statement, and those are the various interests that they have in it. But having said all of that, that users have interest in it, there are some things that are of concerns to users, how they take the information from this financial report. I mentioned something earlier about the layout. It can be confusing and it is different for different companies, right? So at times it might be a bit challenging for users, or especially those that are not financially savvy, those are not savvy in reporting, in financial statement, to get out information from this financial report. It requires you to study it, it requires you to get used to it and get conversant with different types of financial reporting structure. So one of the challenges that they have, one of the concerns of users is that the layout from different companies, different jurisdictions of the world, and they struggle with making out information from it. Another issue, another concern is undisclosed liabilities. This, to some extent, can be misleading, and this, to some extent, can even be traceable to become a financial or tax crime when you are not disclosing all your liabilities, when some are not reported properly. So undisclosed liability in some companies, at times it will make it difficult for users to get the right information from the financial reports of companies. It will also make it difficult to make informed decisions. It will also make it difficult to rely on it. And if you recall, when we started, we mentioned that one of the guiding principles of financial report is that it must be error-free and the user should be able to rely on it. And if they are going to be able to rely on it, it must be trustworthy, and it must be something that is done in neutrality. And when the auditors are reporting, they're always making known in their report that we have made an opinion on this on this organization in this financial report, and these are the basis of our opinion. So, and what they try to do is that all the information that has been disclosed to us, that is what has formed the basis of our report and our opinion. But organizations at times, maybe due to error and maybe due to other reasons, they have reasons they might not disclose totally and completely their liabilities, and that's an issue to those that are using the financial report. Then the other thing that concerns organizations and people, you and I, when we take information from financial report, is the issue of the policies of different companies when it comes to depreciation and amortization, for example. Right? Depreciation, you buy an asset, you're going to depreciate it over time. And every company, by law and even in practice by principle, there are different depreciation procedures that you should adopt. And some financial reporting standard also make it mandatory or compel organizations that are going to use a particular type of reporting standard to report to use some principle in terms of depreciation and amortization. So if you are comparing two companies, but they have different policies when it comes to depreciation and amortization, it can be challenging to you that are using the information. So you might have to go a step further by trying to bring those, getting information about the policy. You see that in the director's report, and you see that in the auditor's report, and you see that in the notes to the account. I can see that, okay, the reason why this asset looks like this is because our depreciation is suspended for this year, or our depreciation, we increase the depreciation value for so much, and things like that. So the accounting policies of different organizations also affect how they report, and this can be challenging to those that are using the information generally. Then, if you recall, when we looked at the balance sheet and the income statement, we said the balance sheet is reporting as at 31st of March. So most of the time, the information that you are talking about in the financial statement, they come out, even it might be when the information is no longer relevant. For example, they are reporting their activities, their financial position between January 1st, 2001 to December 31st, 2001. But this report became available by March 31, 2022. And by that time, 3 months has elapsed. Maybe the information is no longer possible. It's very difficult and challenging to have that information spot on at the time of reporting. So most of the time, the information come out after a particular reporting period. So it might be that at the time the information became available, it's no longer useful to the person that needs the information. So those are the few concerns, let me put it that way, of people that use this financial information. So financial analysis proper. Now, in financial analysis, one of the basic principles of financial analysis is comparing, right? We have said we're looking at different companies, and we say you go into their balance sheet and you see that the company is of a particular size. So you want to compare companies in a particular sector, in a particular industry, and say, oh, typically contractors of this size, typically hospitals of this size, they have a balance sheet of $100 million. So you see that in their financial statement, in their balance sheet. And that is the basic principle of financial analysis. You want to compare. You want to compare year on year. You want to compare vertically. You want to compare company to company and things like that. So what does this comparison involve? It involves comparing current performance to past performance. So we are in 2021. You look at the company, the same company, you look at their profit. You say in 2019, they declared $100 million. In 2018, they declared $70 million. So when you compare 2018 to 2017, you can easily say, oh, there's been a growth in the company because their profit has increased from 70 million to 100 million. There's a net growth of 30 million. That is comparing past and present performance. Also, you can also compare the size of the balance sheet, like I've been mentioning. The company had a balance sheet of $100 million as at year end of 2017. But by the time you look at the size of the balance sheet in 2018, a year after, it has grown from $100 million to $130 million. So you can see that, oh, there is a growth in the balance sheet of the company. The company has gone bigger. That is what comparison is all about. And I also mentioned just now about peer comparison. So you want to look at the organization offering the same service, offering the same product within the same sector, and you want to compare them. They are peers doing the same thing. Contractors. You want to compare civil contractors. You want to compare suppliers, HVAC suppliers. You want to compare suppliers of labor. You want to compare suppliers of services that are rendering the same service in the same industry. So you want to compare them. You say, oh, there's a contractor, maybe Julius Berger, and there's Bettenbauer. Or maybe here in Qatar, you have UCC and you have Lotus. Are they the same? Are they doing this? Are they doing the same type of performance over a particular period? Since they are both within the same region, since they are both doing the same thing, you want to do that kind of pair comparison, and we will see the application of this pair comparison when we go into the application of understanding and analyzing financial information in things like tendering and estimating, in things like you developing a framework procurement strategy where you have to classify contractors and use comparing the size of their balance sheet to put them in the same group, and for framework contracts. Then another thing that you compare against is the benchmarking. Different industries and different organizations have benchmark for different performance indicator or different characteristics indicator. So we can have industry standards where we say that a particular industry, they must have a particular type of ratio or for a particular characteristics for them to qualify to be graded or to be set within that particular framework. Let me use something that we are all used to, most of us. A simple example in water. We all drink water, and most of us have gone through some form of elementary science. In elementary science, we are told that the pH value of water is between a particular range of, I think, 6.5 to 8.5 or something like that. So for you to consider a particular substance as water, when you check the pH value, you will see that it must be within this range. So if you are a company involved in the water business, for example, Seaway and all the others that we are used to, Nestle Water, and you are producing water, in the industry, they will benchmark the quality of water that you are producing against the industry standard. And they will see that, oh, if the water you are producing in your organization meets that standard, they will say, yes, what you are producing is water. That is just the simple analysis of benchmarking. But when it comes to financial practices and things like that, there might be a benchmark. For example, they say for you to be classified as a Class A contractor in the state of Qatar, your balance sheet size must be $100 million. So that is the industry benchmark for Class A contractors. So when you take another contractor, you look at their balance sheet and you see that it is $110 million. You say, yes, they are within that range. But when you see another contractor and you see their balance sheet size is just $50 million, you say against the benchmark of the industry, they don't qualify to be classed as Class A. And I say we should note that we have to adjust for different accounting principles when making this comparison. Recall, I mentioned that one of the challenges that we will see when using financial information is that different organizations have different accounting principles, especially when it comes to things about depreciation and amortization. So when you want to take the financial information, when you want to compare organizations, when you want to compare year on year, when you want to compare against industry standard, we have to make adjustments. We have to look at the notes that relate to this thing and see how we can make better informed decision after making necessary adjustments for the different accounting policies of those organizations. Now, when you are related the information, I mentioned this earlier. I tried to explain. I said there's horizontal comparison. Horizontal comparison is looking at year on year. In 2018, we are just looking at a single line item. Balance sheet size is at the bottom. Net asset value, for example, is 200 million in 2018. In 2019, it is 220. That is relating the information horizontally. That, as simple as it sounds, is the basis of financial analysis. As simple as it sounds, horizontal analysis, the same company, you are comparing their performance year on year. The same company, you are comparing their net profit on the horizontal basis. In this year, they declared their declared earnings. Earning per share is 20 kobo or 20 reals. The next year, it is 30 reals. By just looking at that, as simple as this, you can see that, oh, they have done well. They have increased earning per share over the period you are comparing between 2018 and 2019, period upon period. That is horizontal analysis. Then trend analysis seems to look at, you bring units in a particular financial statement to a base of 100, and you want to see, oh, their profit over this period, over the period you are considering, is increasing because you have a basis. You are taking the profit. You said this year their profit is 100 million reals. Next year is 120 million. But because you have set 100 as your basis, right, and now it has increased to 120. So in terms of trend analysis, the trend shows an upward movement from 100 to 120. It's as simple as it sounds. That is it. So we're not going to go into the nitty-gritty of the calculation to understand what we are talking about. But trend analysis is comparing year on year and you being able to determine that there is a growth or there is a decline in whatever aspect, whatever characteristics, or whatever segment of the financial information you are comparing. Then vertical analysis is talking about you taking the, for example, the basis, what's it called now? The profit, for example, and saying, if I compare the assets that they use to develop, to make this profit, that is what vertical analysis is all about. If I take another, the sales of good, and I compare it to the profit, that is what vertical analysis is about. And vertical analysis is done within the same year. And you can take that analysis and say, oh, within this year, the asset is a ratio, it's 10%. You can demonstrate that the profit is 10% of the total asset. The earning before share, the earning per share is 5%, is 2% of the net asset, for example. Then finally, we'll go to ratio analysis. Ratio analysis is the most comprehensive way of understanding and analyzing financial information. Ratio analysis is almost like what you can call an oracle, right? You just spread it, you open it, and you apply different ratios to the company's balance sheet, to the income statement, and you're able to understand and have more information about how the company is being run. You're able to have more information about what is happening inside the company. When we get into ratio analysis, we will be able to see the application where it tells you if the company has enough money to pay its debt, if the company can be demonstrated, can demonstrate that it will continue to be a going concern. It is through things like the ratio analysis that we can able to make this deduction and have this understanding. Ratio analysis is quite robust in application. It's quite robust in terms of formula. It's quite robust in terms of relevance when it comes to financial analysis, and that's why that's what we are going to center on largely in this presentation, and that's what we will discuss. And even as much as ratio analysis is very important, and we are going to center on it, we will not go extensively into the calculation and all the formulas, because it is the platform is not suitable for it. But what I want us to understand is that there are some tools and techniques of financial analysis called ratio analysis that helps us in financial analysis. And I said that analysis based on different methods that I've explained, horizontal analysis, trend analysis, ratio analysis, they answer different questions. For example, I said horizontal analysis, you can say that year on year, there's been increase or decline in performance. That's horizontal analysis. If you use ratio analysis, for example, acid test will tell you, okay, there is money in the organization, there's liquidity in the organization. So they are answering different questions. Any analysis that you apply out of these different types of financial analysis answer different questions, and they are applicable to different scenarios. Okay, so in ratio analysis, like I said, we're going to center on it, or we're going to discuss more extensively on it. In ratio analysis, it has a strength, just like every other thing. It has its weaknesses, just like every other thing. We'll look at some important notes to compare and to have at the back of our mind when we carry out ratio analysis. So some of the strengths of ratio analysis, it makes it easy for us to identify progress or decline in a business. By the time you carry out the ratio analysis, by the time you carry out, for example, you carry out the profitability of a company, you can see that the year-on-year comparison of how a company is using its resources shows that there's a decline in what the company's activity generally, or there's progress. So through the proper application of ratio analysis, we can determine the decline or the progress a company is making, right? And because these ratio analyses are generally accepted worldwide, because these ratio analyses have the same guiding principle and they rely most of the time or all the time on acceptable practices, analysts within different jurisdictions or at different point in time are able to make the same deduction or deductions that are close when reviewing or when making decisions based on the financial statement. Also, it helps to identify area of concerns and we're able to develop corrective action. Excuse me. One of the things you see in ratio analysis, for example, there's a ratio analysis, a class of ratio analysis called activity ratios. It shows, for example, how a company is able to convert its assets, how long it takes a company to convert its assets into profit, how long it takes, what they call the asset conversion cycle, how long it takes a company to go through the process to convert is what they have invested or what they have put inside the company to turn it to money. So if we go back to what we discussed earlier on under benchmarking, and we see that in a typical company running in this industry, it takes them 60 days to go through the process of conversion. But the company that you're analyzing at a particular point in time, it's taking it 80 days on the average. You will see that there is a concern there and you can quickly address it. Also, in ratio analysis, you can also identify areas of concern. For example, when it comes to gearing or what you call leverage ratio, it's to show how well, to what extent the company is borrowing, right? When you see to what extent the company is borrowing and you see that, oh, this company is seriously in debt, you can now look at it and say, okay, these are the actions that we need to take to bring the company out of debt. So these are the kind of things that you will be able to see from ratio analysis. It also helps in comparison and benchmarking. We can't overemphasize that. I just explained that you compare company to company, you compare company to industry standard, sector standard, and things like that. You benchmark the performance, the balance sheet, the size of the company against what the industry standard is, right? So with the help of ratio analysis, you can determine, and it makes it easy for you to benchmark the financial position, the financial status of the company, or even the financial performance, as the case may be. It's also an effective tool for forecasting, budgeting, and planning. For most of us, the QS, we that are involved with project and construction commercially, we that are involved with procurement, right? We want to be able to forecast. You look at the companies you're dealing with, you even look at your own present company and you look at your ratios and you see how you're doing, then that can help you to plan. That can help you to make informed decisions that will guide how you address things, right? From the numbers that you are looking at, from the growth pattern that you have seen in your organization, from the growth pattern, from the decline pattern you have seen in your competitors, looking at their financial statement and applying the necessary ratio analysis. From the growth pattern you have seen generally in the industry, you're able to forecast, you're able to budget, and you're able to plan and advise your management or even advise yourself when you are the management on the actions to take on how better for you to run your business. And because ratio analysis is almost the same in different parts of the world, in different jurisdictions, because the principles are guided, right, by generally acceptable practices, they are consistent and it gives a disciplined approach to analysis. So there is International Financial Reporting Standard, IFRS, that is accepted generally. There is International Accounting Standard, and all of those accounting principles, all of those accounting guides, all of those standards guide how you perform the ratio analysis. And moreover, the formulas that we use, the principles that we use are consistent. So when an analyst in Nigeria, or when an analyst in the UK, or when an analyst here in Doha is carrying out a financial analysis of a particular report, and he uses a particular type of ratio, and based on that ratio, he gives a report and he makes a decision, because those ratios are generally accepted, because those formulas are universal. If another analyst carries out the same analysis based on that same report, they're able to make consistent and disciplined assessment from those reports. That means what they are reporting, what the information, the deductions that they make from it will be close. The information the information that they make from it will be consistent with the analysis, because the formulas are universal, the formulas are generally accepted. So these are some of the strengths of ratio analysis. Notwithstanding that they have strength, there are also weaknesses. I mentioned this to some extent. I said it could provide limited information when it comes to when you use the statement on its own. So, for example, you look into a company's financial statement, you see a lot of activities. Let me say, for example, cash flow. You see how money is moving, and you look at the timing. It is not enough for you to make all of the financial, decision from there. Another thing that you might need to look at what is happening generally in that industry. Another thing that you might need to look at the company's particular financial position, not just from their financial statement, also from their bank account statement. So it can tell you how money is coming in, how money is going out, and what particular transaction, if what they have reported in the financial report is substantiated by other information, information from other valid sources, such as bank accounts. And auditors will always tell you this. They use the bank account statement, and they make sure that, if you have accountants working in an organization, one of their challenges and one of their tasks when they are preparing their reports and things like that is that they ensure that whatever they are going to report in the financial statement is supported by information from other sources, most especially what they have in their bank finance statement. The bank finance statement, we cannot be edited, we cannot be corrected or adjusted. Must match what you are reporting in your financial statement. So one of the weaknesses of the financial report is that it might provide limited information, but to counter that, you have to look at that information with information from other sources. Now, the ratio that you use on the sheet figures, they are only true at a particular period in time. I mentioned that, and we have looked at the typical specimen of a balance sheet. It's reporting at a particular point in time, right? It's reporting, said, this is the financial position. This is the balance sheet of this organization as at 31st of December, 2020. And when you are going to do your analysis based on the information contained in that report, the analysis might only be relevant or may be true only for that period. The situation of that company might have changed between the time you are carrying out your analysis and the time the report was done. So we must, as you become as you practice more using this ratio analysis, we will know how to adjust for all of these variants in terms of times of reporting. And I have mentioned this before, and I'm still emphasizing it, that the different accounting policies may distort the information provided when comparing different companies. We started by saying that the basis of financial reporting and the basis of financial analysis is in comparison. You are comparing year on year, and you're comparing companies with companies, you're comparing pairs, you are doing benchmarking. But if what you are benchmarking against, if the companies you are benchmarking against, if the companies, the pairs that you're comparing have accounting policies that are very, very far apart, then your ratio will not be telling the true story. Your application of the ratio analysis will be misguided. So for things like this, that's why I emphasize that we should look at the auditor's report, we should look at notes to the accounts, and we should find a way to adjust and bring those two reports that we are comparing at a particular time to the same basis, so it can make it very easy to make informed decision. Then important note: ratio analysis itself is of no use, right? It should be related to or compared with another element for the information to be useful. So I mentioned this as one of the way to combat the weakness of ratio analysis. When you look at the ratios and when you look at the financial report and when you calculate all of these things, you must have another benchmark, you must have other information to compare it against. Like, for example, we do the ratio analysis of the company, you see that in terms of liquidity, the liquidity is bad, right? But looking at it and looking at the number is low. To what extent does that tell you information if you don't compare it to, if you don't look at it against what is obtainable within the industry? So the companies in this industry, this is how they perform when it comes to their liquidity. It is always 0.1, it is always 1, it is always 2.1. The range for most of the companies in this industry is between 2. When it comes to liquidity ratio, it's normally between 1.0 and 1.5. So when you do the ratio analysis of the company and you see that it is 1.2, it's only when you look at that 1.2 against what the benchmark of that industry says, that is when you have the complete information. Then in doing ratio analysis, you must have a clear purpose. You must understand the reason why you are doing the ratio analysis. You and the people that you're providing in the information to must have the same purpose, the same understanding, the coming together of minds concerning the calculation. And that will guide how you apply the different principles. That will guide how you apply the different formulas. That will guide how you make use of the information you are getting from the ratio analysis. Then a single year account is not adequate for proper analysis. I mentioned this, and I also said that a tree cannot make a forest. A tree cannot make a forest. In the structure and the layout that we have seen that in doing the ratio analysis, we look at trend analysis, for example, year on year. Before they were making 10% profit, now they are making 15% profit. That is trend analysis. In 2018, the size of the balance sheet was 20 million. In 2019, it has grown. That's an increase to 30 million. So a single year analysis is not enough. You have to compare it with years. As a matter of fact, in most financial statements and in some jurisdiction of the world, they will mention that in a typical financial statement. So when we look at the balance sheet, they must provide 3 years for you to look at. They must provide 4 years. So on a particular page, you will see the balance sheet size of 2018, 2019, and 2020. So you can do the comparison. You can use it to understand the company. And even for us, when it comes to application, when you are doing tendering, for example, and you're doing pre-qualification, you want to look at the contractors that you want to pre-qualify. You want to see that over a period of time, in the 3 years that they have been in existence, they have been increasing in performance, or they have been declined, and that can guide you how you pre-qualify them or you select them. You must bring the comparison to similar basis when you are doing this. Compare apples with apples. Compare apples with apples. One of the things that we look at inside here is what we mentioned before. Because different organizations have different accounting policies when it comes to things, especially in amortization and in depreciation, things like that. In those accounting principles, it might make it difficult for you to compare different companies. So you must compare apples to apples. And to do that, you bring the reporting or your analysis to equal or uniform basis, so you can do a proper analysis. Then you want to be mindful of the distortions, assumptions built into the account. Review the notes to the account. As a matter of fact, I said always review notes to the account. Now, this, what I call distortions or assumptions, right? They are, so by law and by regulation, they should be explained. And in the auditor's report, in the notes to the account, even in the managing director's report, all of these things are normally explained so that we can take information from there to guide how we make deductions or to make informed decisions from those accounts. There will always be distortions, and the people that are reporting will make assumptions on some things. For example, in the amortization, they are saying that because of something that is coming up, we have assumed that our companies will do like this in the next year. So that is why we are doing our amortization this way. That's why we are increasing how we are depreciating a particular asset. We are no longer using single line depreciation. In the first year, we use this type of depreciation principle, but in this particular year, we are using this because of this. All of those distortions, all of those assumptions are built into the financial statement. And if you don't review it properly, it will affect the quality or the information or how your ratios are calculated as well. So these are a few important notes that we must look at. We must be mindful that the information in the financial statement and the ratio is not enough by itself. A tree does not make a forest. We must be clear on the purpose. And when we are making comparison, we compare apples to apples. And as much as possible, be mindful of distortions and assumptions that are built into the financial report. We can see this in the note to the account. We can see this in the auditor's report. We can see it in the managing director's report to guide how we analyze the financial statement. So what does financial analysis involve? Calculation of ratios using disclosed information. The disclosed information that are contained in the financial report, that is what it involves, calculating ratios and using it, doing comparison of the calculated ratios. So you calculate the ratios, then you do comparison in the first year. If let's say we are comparing two different companies. Company A, their liquidity is 1.2. Company B, their liquidity is 0.9. So that shows that comparing company A to company B, company A is better because their liquidity is better. Things like that. So you calculate the ratio, you compare the ratio, then you draw inferences from it. What I just mentioned, and when I say I can draw inference that because the liquidity of company A is higher than the liquidity of company B, the inference I'm drawing from it is that company A is better. That is just an inference. Then we now go to the last part of it, which is you can now make your recommendations and deductions from that analysis. So you did your calculations, you did the comparison. Maybe you're comparing A to B, or maybe you're comparing the same company year on year. You now draw inferences. Because of Because of the numbers that you are seeing, one company is better than the other. One company is stronger than the other. Then finally, what do? You make a recommendation. Because company A is better than company B, I recommend that we should do this business with company A. Because company A is better than company B, I recommend that we should partner and have a JV with company A. Because in our company, we are making progress year on year, I recommend that we should expand our asset, and goes on like that. So that is it. You do the calculation, you compare, you make inference, and finally you recommend or you take action based on the inferences. So we have been talking about ratio analysis. We are talking about financial analysis, and I said that we are centered on ratio analysis. So these are the main categories. Note that it is not the type of ratio analysis, they are just the main categories. We have profitability or performance ratio, we have liquidity ratio, we have efficiency or activity ratio, we have gearing ratio, we have investment ratio. These are just classes, like big umbrellas of the different types of ratio analysis that are available out there that can help us make informed decision, right? In terms of profitability, it's we have a type of profitability called return on capital employed. So you want to see that the capital you have employed, what you are gaining from it, is a measure of the profitability of the company. You have return on total assets, you have return on equity, you have profit margin, you have asset turnover, right? Asset turnover, all the assets that you have in your company, all the assets that is in the company, how well they are being converted to profit. You want to measure that. That gives an idea of the profitability of the company. Then I mentioned something when we started about money, about cash being the blood of businesses. And for us to determine that, that is in the liquidity ratio of the company, or we call it the quick ratio, which is simply current assets over current liability. The assets over the liability gives the ratio. If assets and liability is 1-to-1 and your quick ratio is 1, that is fairly a good company. What that indicates is that the company's assets is able to meet the company's liability, especially in the short term. Because when you're talking about current asset and current liability, you're not. It is what you have. It's regarding short term. The operative word that you have there is what? Current assets. Current assets, right? Because current assets. There's also fixed assets, but for the purpose of liquidity calculation, you use current assets. When the asset is able to meet the liability, then you are okay. So in the short run, when a company's asset is able to meet the company's obligation in terms of its liability, the company is able to pay salary. The company is able to make supplies and pay its suppliers. The company is able to buy the things that they need in the short run to run the business, right? That means the company has enough liquidity to run its business. The company has enough liquidity, especially in the short term, to meet its liabilities, to meet its obligation when it comes to payment and things like that. And for lending organization, when they look at the company's books and they see that the current assets, the current ratio of the company is less than 1, it shows that the company has a financing gap, at least in the short run. Then the lending organization will now have to determine and decide the type of lending they want to do to it, for that company, to help the company, come out of that particular situation, to be able to meet his liabilities in the short run. So liquidity ratio help us to know if the company has enough funds to continue to run, to meet its, especially its what they call short-term debt. And you must, for us, as an interesting thing, maybe going forward, all of us, after this discussion, we'll ask our company's accountants and we'll look at them and say, we want to see our company's books, and we see that we want to see our liquidity. Maybe our company is able to pay our salary at the end of the month or in the near future. We want to see if our company is liquid enough. It is in things like this that we see, because our salary is like it's part of current liabilities that the company pays every now and again, every month, or as the case may be. Then we have efficiency ratio. Efficiency measure efficiency in terms of management and working capital. Basically, one of the things that the efficiency ratio does is that it measures period, right? That it takes a company to convert its assets into profit, into liability, more or less. So let me give an example. Inside what I've mentioned here, I say stock days and things like that. So if you are just a simple organization doing buying and selling, you buy, you keep something on your shelf, how long does it take before that thing is sold? And how long does it take before you're able to even collect the money when you sell in debt and things like that? So activity ratio helps to explain that. And activity ratio is relevant to us, most of us in construction industry, because we will see the payment terms for our contractors and subcontractors, where it says that the payment is 45 days cycle, the payment is 60 days cycle. So the relevance of that and the evidence of that will be seen when you do things like activity, and you see truly the company is converting in 45 days, is converting in 60 days, then you can compare and make decisions. Then also we have the gearing ratio. I mentioned that too, that it shows how well, I mean, to what extent the company is borrowing, if the company is heavily geared, if it's really borrowing to be a company. So if, for example, you want to go into a joint venture, or you want to select a contractor or pre-qualify a contractor, then you look at their numbers, you see that the company is heavily in debt. It is through this gearing ratio, this ratio that will advise you or guide you and let you know that, the company is really in debt. If the company is really in debt, do we really want to do business with them? Do you want to class them? What can we do? Should we still pre-qualify them? It is when you look at the things like gearing ratio. Then investment ratio. Most of us are aware of the investment ratio. I mentioned this as well. Earning per share and things like that will tell us, okay, if I invest so much in this company because they have been paying shares year on year, they have been paying dividends year on year, and the dividend yield is good, I will make so much in the near future, things like that. So price per earning ratio and all of those, that will guide us on how we concerning the investment, or how we place investment in organization. Excuse me 1 second. And as we go on, so are the broad categories. Then understanding the facts behind the figures, we must ensure when we are trying to make sense out of this financial statement, and when we are doing this ratio analysis, we must read the notes to the accounts, the director's report, and the auditor's report. That is how we make sense of these ratios. That is how we make sense of these numbers. That's how we understand what is behind the numbers. And that's how we're able to apply it properly in making informed decision. If we just look at the ratio, I explained that one of the weaknesses of the ratio analysis is that the ratio in itself does not tell any information. The ratio in itself is not enough. But we must now take the ratio, look at other supporting information from other sources, financial bank statement, look out for other information, auditor's report, look at other information, director's report, and look at other information, notes to the account, and see what has happened, even concerning the company's policy. Then we are able to make better and informed decisions from the ratios. In application, for us, with the tendering and procurement professionals, what do we understand and how do we use this information? How do we use this financial analysis in our day-to-day business? The one that is most common to most of us is in tendering and procurement. When you want to pre-qualify contractors, when you are selecting even suppliers, when you are selecting subcontractors, you look at their financial statement. You look at it and you want to check if, for example, the contractor liquidity is okay. They're able to meet their short-term liabilities. If you look at their ratio, you do their liquidity ratio, and you see that this contractor does not have enough money to even run its business. That is an a red flag. That's an indicator that you should stay away from that contractor. If you look at if you perform the gearing ratio on the contractor and you see that the contractor is heavily in debt, you don't want to go to such what's it called? You don't want to pre-qualify the contractor because you are already seeing the red flag. So it is it's in our understanding of financial analysis that we're able to know. It is in our understanding of performing ratio analysis that we're able to determine that, the contractor is in debt, the contractor's liquidity is bad. Another thing again is in terms of classification, if you are designing a framework arrangement where you want to pre-qualify contractors, you want to have selected contractors and you put them in a framework and you say, I want to have class A contractors, I want to have class B contractors, I want to have class C contractors, and you say class A contractors, you must be seen to be doing, they must have stayed in business for 20 years, 30 years. They must be doing businesses, they must have done road construction of 100 million. They must have done road construction of 30 million and things like that. Another thing that will inform you is that you want to look at their balance sheet size. What is the true value of this company? If you say you want to classify as class A contractors, the true value of the company, you are seeing in their balance sheet that is merely 100 million. And the kind of jobs that you have, it's in hundreds of billions. You want to reconsider and say, oh, this contractor is not up to class A. Maybe it's class C. They'll be doing smaller projects. Under contract claims management, under application of ratio analysis, most of us are aware of head office overheads when it comes to claims, when it comes to prolongation costs, when a contractor is able to claim that because the employer has prolonged the project due to employer's delays, there's been prolongation, and the contractor wants to have claim for head office overhead. Most of us are aware of Hudson formula, but there's been an extension of Hudson formula. In Hudson formula, when it comes to contractors' claim calculation for head office overhead, Hudson formula uses the contractor's profit and overhead as can be established from the contract. And before now, in cases that have been determined in the past, that was reliable. But if the court has established that the reason for head office overhead is what the company or the contractor could have made if they had been engaged in other projects, and the contractor has claim for that, and it had been established, and that it had been established legally, contractually, that the contractor has a claim for, basis for that, for such claim. It is inappropriate to now use the profit that you have made on that particular project at hand as your basis. So what the courts have done over time is that they have tried to use a basis that is more central and more akin to the contractor, and that's what gave birth to the Emden formula. So in the Emden formula, which is similar to the Hudson formula, is an improvement on the Hudson formula in that it uses the contractor's profit and overhead that is established from the audited report of the contractor. We can see the difference here. In Hudson formula, it uses the profit and overhead that can be established from the contract, inside the contract document, inside the bills of quantities. But in Emden's formula, it uses the profit and overhead that is derived from the contractor's audited report. So it's our understanding of the financial ratios that we're able to deduce and make effective deduction and do a proper calculation of the profit of the contractor and apply it properly when it comes to claims management regards head office overhead. Also, in commercial management, right, when you want to go into a joint venture, for example, I have tried to discuss something like that. In most instances, contract required joint venture. Maybe you have a contractor that is competent in one particular discipline, another contractor that is competent in another discipline. You want to look at the business of that, the organization you are going to joint venture with. You want to look at the business of the organization that you want to select as your subcontractor, as a supplier. And the thing that you want to look inside it, the size of the balance sheet, I explained that. You want to look at how well they have performed over a period. And this analysis of the ratio, this analysis of the financial statement is what will guide us as procurement professional to be able to make such informed decision. Then concerning business development is not limited, right, to us and saying that we will continue because we are working for an organization and we are just earning salary, won't look at business development. Every now and again, even the company that you are working for might give you a task and say, oh, within this industry, let me give an example. As a company that is providing quantity surveying service, within this quantity surveying and contract management service, can you, as a quantity surveyor, as a procurement professional, can you analyze what our peers are doing when it comes to claims management? Is that sector developing? So you look at the companies that are extensively doing claims management, you look at their reports, their financial statements, you come to them and say, yes, look at in their financial statement, this company is actively involved in claims management. Their director's report says so, their auditor's report says so. And when you look at their growth year on year, there's increase in their balance sheet. When you look at their profit, in their profitability, you do your ratio analysis, you see that there's increase. I can advise your management and say, yes, concerning business development, what we should be doing as an organization, because we might have the skill set, but we are not pursuing it. But by the time you do this industry analysis and you see what people are doing and you do their financial analysis, you can see and you're able to advise your management effectively that, oh, we can also go into this. It's a venture for us to do. And if it's also in contracting, for example, you're a contractor, all you have done so far is in just actual construction, maybe in buildings, maybe in infrastructure, then but there's the opportunity for you to just go beyond just doing contracting. Because you have the capacity, you might be able to develop and add on to your business an asphalt processing plant, for example, and so that it can be the one to be supplying your competitors and even other suppliers asphalt. Then how do you do that? You look at other businesses that are around you, you look at other contractors, you look at their financials, you see notes to their account, you see that they are declaring profit, and by the time you read it extensively, you see that the source of those profit they are making, right, the source of their growth over time has been from what? From other businesses that they have gone into, that they are diversified, right? And that is only possible when you are able to understand the financial, when you're able to do the proper ratio analysis, when you're able to do the proper financial analysis of that company. And you can advise your management that, oh, there's an opportunity here. There's an opportunity for business development while looking at the financials of this other organization. Then finally, in business assurance and audit, every now and again also, we are called on as procurement professionals, as quantity surveyors, as contract managers, as auditors and accountants to look into businesses of others, to look into what has gone on in businesses over a period of time, for us to look at it and see, okay, what has gone wrong, what has gone right, what are they doing properly, what are they doing according to what they said they would do, what are they doing wrongly. We can say that, oh, because we are not accountants, we might not be called to do this, but we need to have the understanding of what the accountants are even going to recommend to us, what they're going to tell us, because they'll come up and they'll do their analysis, they'll do their report, and they'll make their recommendations based on the analysis. But when we understand, for example, a contract has gone bad, the contractor is unable to complete, then the accountants come and say, oh, we reviewed what happened during the process of construction. The contractor struggled. Why did he struggle? He was unable to meet his current liabilities. He was unable to procure things when he's supposed to procure them. Why? Because his liquidity was bad. His liquidity was below 1.0. His current asset over his current liability, the liabilities was higher. So the contractor struggled over that period. So we had that understanding. And because we have an understanding of ratio analysis, we quantity surveyors, we procurement people, we commercial people, we're able to advise our management, we're able to advise our clients properly, and we have the understanding. Another thing about business assurance, when it comes to, you look at an ongoing concern, a contractor that's already on a project, the project is a 5-year project, it's a 4-year project, and you have gone 1-2 years into the project, and you are seeing some indicators, the contractor is not generating what is supposed to generate. His rate of progress is becoming slow. For example, his subcontractors are having issues with him. His suppliers are having issues. You are going to progress meeting and you're seeing that what you have projected where you will be, that is not where you want. That's not where you are. By the time you say, okay, let us just take a pause. Let us even go back and understand why we are where we are today. It's possible that you did a lot of analysis in pre-qualification. It's possible that maybe there are some information that they were distorted at the time. So your assumption and all of those things were not correct. So by the time you go back into the financial reports and you try to do your analysis and ratios, you can come up to it and say, yes, oh, we made some mistake. It is clear in the contractor's financial report that they will struggle financially, and that's why we are where we are today. Their ratio is bad. It's the information we are seeing when we thought that the contractor was profitable is not because they were carrying out construction, but because according to the notes to the account, their source of income was mainly from the other activities that they are involved with, which include selling things, maybe includes making supplies of asphalt, for example, or making supply of other building materials. So it is in things, it is in the proper application and understanding of financial reports that we are able to see things like this. So generally for us, the procurement professionals, we understand the application of financial analysis and ratio analysis in our day-to-day business in the areas of tendering and procurement, in contract and claims management, the application of MDENS formula, in commercial management, requalification and things like that, in us venturing into other type of business, especially in allied industry. And of course, when things go wrong, when you want to audit, you have business, concerning business assurance, we want to be able to look at the numbers and see, let the numbers tell the story and let the facts behind the figures guide us on how we make a decision. And in summary, and there's a recap to what we have discussed so far. I hope I wasn't too fast in my speaking. I was just trying to cover the time. I know that we are running out of time, but as a brief recap to what we have discussed so far, we have discussed about brief overview of financial reporting. That's where we discuss all the different standards and why people need these financial reports, what they do, what we can do about what the financial reports are, the components, the balance sheets, the income statement, and all of that. We also talked about the ratio analysis, the financial analysis, using the ratios, how to use the information, the strengths and weaknesses of it, things we should look out for, how we make the adjustments, the way to the extent and the extent to which different companies' policies affect what they are reporting. And finally, and just briefly, we talk about the application of financial analysis for us as procurement professionals in our day-to-day business, what we see, what can happen, what can go wrong, and things like that. And how we can use the information from financial analysis to help us make informed decisions, how we can use the information from financial analysis to help us advise our clients properly, how we can use information from financial analysis to help us guide our procurement, to help us in contract management, of course, MDENS formula like I mentioned, and to help us in business development. So basically, that is the summary of our discussion so far, and I hope that we all enjoyed it, even though most of us have been very, very quiet. So we'll move on to the next stage in a short period, and we can have questions and contribution from all of us. Thank you very much.
Thank you very much for that wonderful presentation. We are most grateful. We are most grateful for your efforts and that beautiful presentation that has taken us far, far into the world of financial reporting. We already have questions in the chat section. Actually, somebody raised his hand. I put him on the queue, but he has disappeared now. Okay. The first question is from Mr. Ayodiji Akekole. The question is, with this incidence of recent funny information we get in the financial indicators, how do we as country surveyors advise our employers about leveraging subcontracting management?
Okay, I will approach that by saying this. We say the financial information that you get in the financial statements, we cannot rely on that information alone to advise our clients. And I explained earlier on that using the financial reports is just only the beginning. A tree cannot make a forest. So we take the financial reports, we take the company's account statement, we take industry reports, we take other information that are available to us, and we use it to substantiate whatever it is that we are seeing in the company's financial report. For example, you shortlist some contractors for selection, you review their financials, and you are seeing that their ratio is bad in terms of liquidity, right? That should be something that you should be able to guide your client on and tell them the numbers are not looking good for them. However, if we see what they are doing in terms of their their bank statement, you might be able to guide further. Or in another instance, if you want to rely on that financial report alone, you see a company that appears to be growing in terms of balance sheet. But if you go a step further in their notes to the account, you can see that their balance sheet is growing. But why is it growing? They are acquiring assets. What assets are they acquiring? Is it that they are using in construction, or is it that they are using in production of building materials that they are doing by the side? So for our information and for our guide and for our advice to be comprehensive, we mustn't just rely on the financial report alone. We mustn't just rely on the ratios alone. We must have a compendium of information, a compendium of analysis from different sources that are reliable and objective, and reference them while advising our client and while making this decision. I hope that is adequate to guide.
Thank you very much. Further questions?
Hello, everybody.
Hello. Who is that?
Good day. Can I thought you said I should give my question.
Okay, I will call you. I'll call you. I already put you on the queue. Okay. How come some robust companies with huge financial muscles and excellent financial statements and annual profit, reports, still go bust not long after the release of their financial statements or annual reports? Is it that these financial statements or annual reports don't foresee the immediate future, or what?
Okay, I tried to explain this. I said some of the what you call the weaknesses of the financial report. We say a balance sheet, for example, it reports the information at a particular point in time, right? And we say one of the weaknesses is that the information will become available at a time when the situation of the company might have changed. So the reporting period is December 31st, for example. And by the time it takes the auditors to go through the process to prepare the report, it's already April, May, June. And a lot of things might have happened between then and now. Let me give an example. A company completed their activities December 31st, 2020. And they started reporting things, and they are saying that they make projections. One of the things that we do with financial reports is to make projection and planning. By March 2021, I want to say March 31st of March 2019. By February, March 2020, there was coronavirus, things that we all could not have planned for. And whatever budgeting, whatever planning that you might have done, by the time you're going to come back and say, okay, the projections you are making based on those financial information as of December 31, and the situation of the company by June 2020, it will be different. So things like that happen. But let us now be more general. Most of the time, if you read through the financial report and their auditors have done what they are supposed to do, and they have been fair, and they have been impartial, and they have been neutral in their reporting, there will always be indicators there. And also, if the companies have maintained the books the way they should, without being criminally without being indulged in criminal activities and criminal reporting, then whatever you see as those companies that they say they are financially sound should be like that. So we can take a typical case of Enron. We can see what happened in the case of Enron. There was a problem, but it was covered by the auditors. There was a problem, but it was covered by the auditors, and it was covered year after year. So if you report as you should report, most of the time, the things that can cause a company to fail or to go bust after a short period of time would have been seen, and the red flags, the indicators would be there. But if it is covered by the auditors, if it is covered by the internal auditors and the accountants of the companies, and they have been doctoring books, it's possible that those things will not be seen. But without that, but all things being equal, and people reporting as they should report, this will be seen. And it's possible also that it might not become evident in a short term, but over a longer period of time, all those things that they are trying to cover up and all of that will become evident, and people can make the decision. Then I can see a second question here. What are the demerits of financial statement and annual reports? It's what I said. The report might come at a particular time when it's no longer relevant. And also there are the policies, the reporting policies of different organizations might be, they are different. So you must understand that, you must go a step further and understand their reporting policies and how it affects their financial reports before you make your decision. Then again, the layout and the structure is different from jurisdiction to jurisdiction. And so that is a few, let me say the demerits of the financial statement. Then generally, there can be undisclosed information, and most of the time, when you have undisclosed information, undisclosed liabilities, or undisclosed assets, or undisclosed processes and things like that in those information, it could be criminally, it should have criminal intention, and that can be revealed in future. Okay, next question.
Yes, Ade Ajayi raised his hand. Ade Ajayi, 1, 2, 3.
Hello, good day, Mr. Chairman. Thank you so much, Mr. Bola.
Yeah,
insightful. Please, my question is this actually. The financial report, is it quarterly, is it annually, and how often do they update it? Like you said, because now things is volatile now. Things change very quickly now. So and you said this thing has to be like correct. The integrity has to be there. So how often do they update their financial reports? Let's say the blue chips companies, the big companies, the big short companies. How often do they update their financial reports? That's my question. Thank you so much.
All right, thank you very much for that. It's informative too for us to rehash. I started by saying that financial institutions is a heavily regulated industry, to the extent that we are having what they call cross-border regulation. So the regulation that is obtainable in another jurisdiction affects how we do business in another jurisdiction. I can use the banking industry, for example, where they are having Basel I, Basel II, Basel III on capital adequacy and things like that, how the banks are structured. I'm telling them that this is how you classify this is how you do provisions, this is what you classify as assets, this is what you classify as retained earnings and things like that. So because this industry is heavily regulated, because the way things happen are guided, the reporting period too is regulated. And yes, the industry generally understand that things change regularly. So for most exchange commissions, for example, and most financial regulators, they say the big companies, most publicly quoted companies, they must report some form of financial disclosure every quarter. And at the same time, because they're reporting a quarter, there's another report that comes out in the middle of the year, right? They give them the financial reporting period. They say your financial reporting period should be from January 1 to 31st, like they did in Nigeria a couple of years back. They said the banks and all of that, they must report from January to December, and you must give something in the middle, you must give another report in the middle. And if for those that are actively involved in trading stocks, you will see that because of this reporting and all of that, it affects the shares and the share price of those companies, and those things can be easily manipulated. So because of that, everything is regulated. The timing is discussed. I mean, the timing is by the law. So you have regulations that say that you must report every quarter. You have regulations that say that they must report. They should report every 6 months. And when they have a reporting period, the reporting period might be January 31st to December 31st, but those reports must be available a month after that period, or 3 months after that report. So generally, you will see companies. You say, let me use an example. Banks in Nigeria, they always give their financial year-end report 4 months after. So from December 31st, from March 31st to around throughout the month of April, their numbers will be coming out, and that can inform people. So the reporting periods are regulated. The reporting periods are according to the financial organization having jurisdiction to control the activities of the companies within the jurisdiction.
Okay, another person was trying to raise his hand, but eventually didn't raise his hand. If you have more questions, please let's comment. Okay, Mr. Abraham Mure.
Sorry, I didn't actually raise my hand. I was trying to check on you. There is a guy that raised his hand previously. Okay. I was just trying to check on him if he's still around.
Okay. He's no longer there.
Yeah, the guy is there.
He's here now, right?
Yes.
Stanley Oji, aha. Yes. Come along, Mr. Stanley.
Okay, good afternoon, everyone. A nice presentation. My question is, some organization, especially here in Nigeria, in a bid to avoid tax, you can see some of them like presenting two different financial statements, especially when they want to get job. Like some, they will present a high to show that the company is very buoyant. And sometimes also for the tax, you see another financial statement showing a very low tax. How can we verify some of this record, especially while doing pre-qualification of tender?
Okay, thank you, Stanley, for the question. It's good that it's nice to have you on this platform attending. I think this is similar to the question from Mr. Ayodeji as well. What I mentioned about the fallback or the weaknesses of financial statement is that it is not. A tree does not stand alone. You cannot rely on the information in the financial statement alone as a source of information to make your decision. You must look for other verifiable sources, other sources to rely upon to support what you have in the financial information. For example, I mentioned the bank statements. For example, you will see the activities of the organization. So, for example, when you're making your pre-qualification, it's not just enough for you to take what they have in their financial statement. You might need to make physical inspection to the site, physical inspection to the organization's office to be able to make this deduction. Because yes, companies criminally now, you have to underline that word, criminally doctor their books. They don't declare all what they should declare. And I also mentioned that in the presentation that one of the weaknesses that you might have undisclosed liability or undisclosed information, right? So you must go a step further. After the financial reports, after the analysis, go look at the auditor's report, look at the notes to the account, then look at other supporting information, bank statements, physical inspection, and see what is generally happening in the industry, see what is obtainable in the industry, in the sector. Do your benchmarking against what is standard, what cannot be doctored. Then you'll be able to tell and throw more light on the information in the financial report, and you can make better informed decision and guidance from there. Thank you.
Thank you. There is another question.
Okay. Okay. Thank you.
Okay. You have more questions, please. Go ahead. Go ahead. You
yes,
more questions.
Just in further to that is another, like you mentioned, the issue of classification of contractors. This one of the other challenges we're having here, how to grade different contractors into like grade A, grade B, or any grade based on their financial standing. It's always tough to really achieve that here. Most times it's just based on intuition or the level of experience that you perceive of those contractors.
Okay, in that regard, I mentioned, if you have established your basis for comparison, let's take, for the purpose of this discussion, let us take the size of the balance sheet. The balance sheet tells you the financial position of the organization at a particular point in time. It tells you the class of the organization, more or less. This is a balance sheet size of $100 million. This is a balance sheet size of $200 million. That is the size of the company at that particular point in time. But when you take that information, you don't stop there, because inside that financial statement, they'll mention that they have assets that is giving them that value of money. They will mention that they have retained earnings that is showing that. They will mention that they have some money in the bank that is showing that. You can go a step further by requesting for their bank statement. You can go a step further by going to make physical inspection of those assets that they claim. You can go a step further by asking for the papers of those assets that they have described in their financial statement, saying that they have so much and they are worth so much. So that will now give you a better way to classify them. That is one thing. And another thing is, in your classification, you can see that some, because of their operation and because of how the management is running the business, they are not making enough profit. They are not getting involved in enough business to show that the company will be a going concern. All of that information you can get from the financial analysis that you carry out on their financial report. And but you won't rely solely on the information in the financial report. You have to provide, you have to request for, or you have to step forward directly or indirectly to get additional information from supporting information around what they have provided in their financial statements. Information that cannot be changed, information that cannot be doctored, and one of the most reliable is what you have in their banks. That cannot be doctored, and that must be, and you use that to supplement what they have in their financial reports. All right. Thank you.
Any other question?
Mine is not just a question. Please, let me just come in, because sometimes a QS who is inside an office who is doing analysis may not really have this time going around to get this additional information. Like what we have in Bahrain, where we have an independent department in Ministry of Works that do the classification of contractor. You already know, like if you are in Ministry of Works in Bahrain, you already know these are Class A contractors, these are Class B, Class C, so you go through this. So the issue of doctoring and trying to micromanage information is removed. So like what the question Stanley asked, it just have to do with looking for if there is any legislation that can be enforced, or if NIQS, for instance, can look into this matter and say, okay, they can set up an independent body to be able to do contractor classification in Nigeria. I think that will go a long way to help, to remove all this trying to micromanage information, because you won't get the truth. Because except you have a classification board, where the classification board can say this is contractor grade A, and they will have done all this independent analysis and classification, not during the tender period, because sometimes contractors are just coming on board, they are going down, they will just try to manage their information and just submit it. You give them work, and that is a problem. So this is just my only two contribution and question. If there can be any form of legislation anybody can propose to get something like that in Nigeria to help.
Well, I'll be surprised if the federal government ministries don't have classification criteria. But other companies, other employer companies are supposed to have, and if they don't have, you as consultants, it's better for you to develop certain criteria to classify the contractors and suppliers. Yes, and as it is suggested also, I think it's advisable if NIQS can do something to standardize the classification in the industry. That is provided that the government has not already done that. Thank you. Let's, Mr. Yahya. Your question, Mr. Yahya. You are on mute. If you are speaking, you are on mute, so we cannot hear you. He was raising his hand. Maybe it was a mistake. Okay, anyway, we've spent our 2 hours. We are grateful. Let me just, before we go, let me acknowledge the comments in the chat box, congratulating our presenter for the presentation. Mr. Ayodele Akinkole, Mr. Ayodele Faleye, sorry, I don't know, Annette Oke, Onyikonsola Dejonwu, Dr. Femi Balogun, Bill Viado, Ali Yunis, Justice Okechukwu, and Mr. Yahya. All these people have praised your presentation. Said, using different adjectives. So yes, it's a superlative performance. So we thank you for that. We thank our participants too for taking part in this presentation. Next month also, we should be holding another one. Invites will be sent out. We'll be looking forward to see you then. Until then, I'll be saying from here, bye-bye, and see you soon.
Thank you all for coming. Thank you for attending. Really appreciate your time. And see you guys soon. Thank you all.
Yes, individually, you'll have to log out.
Yes.
Look at that red button and log out from there.